Something that every Bitcoin investor needs to understand are the psychological traps that can mess with your head and wreck your strategy if you're not careful. The thing with Bitcoin is that it's not just a financial asset, it's a weird, volatile, and polarizing thing. It's not like buying some steady dividend stock or real estate property. With Bitcoin, you're constantly bombarded with emotional triggers, fear, greed, euphoria, regret, all that sort of stuff. And if you're not careful, these sorts of psychological pitfalls can become massive blind spots. So these are the 5 most common psychological traps Bitcoin investors fall into and how you can avoid them. So number 1 is FOMO, fear of missing out. It's one of the most powerful emotions in investing, and with Bitcoin, it can really hit you hard. The FOMO trap is that, nagging voice in the back of your head when you see Bitcoin pumping and you're not in the game. It's the feeling that you're missing out on the next big move, that everyone else is getting rich while you're just sitting on the sidelines. It can make you throw your carefully thought out strategy out the window and dive in without thinking. But the thing is that Bitcoin is notorious for these massive sudden spikes followed by brutal corrections. So if you buy at the peak because of FOMO, you're setting yourself up for a rough time when the correction hits. The key to avoiding FOMO is having a plan and just sticking to it. If you're buying Bitcoin, do it based on a long-term strategy, not because the price is spiking on X or Twitter or whatever. DCA, or dollar cost averaging, is going to be your best friend in these sorts of scenarios. It's not exactly glamorous or anything, but it's definitely effective. And it keeps you from panic buying at the top and regretting it a few weeks later. Next is confirmation bias. So this is when you only pay attention to the information that supports your pre-existing beliefs, which probably a lot of Bitcoiners are guilty of. And it's true, if you're a Bitcoin believer, you might find yourself only consuming content that reinforces your views while ignoring anything that challenges them. This can create a dangerous echo chamber where you can miss critical signals that could save you from a bad investment decision. So something you can do to avoid this is actively seeking out opposing viewpoints. Go and listen to the critics, the skeptics, the cautious voices. A good example is if you go and watch some videos or podcasts that he might have been interviewed on, and I'm talking about Mike Green. He's got some really interesting points on the whole slightly anti-Bitcoin sort of stance. Read up on the risks and potential downsides of Bitcoin. It doesn't mean you have to agree with every critic, obviously, but it forces you to confront the situation for what it is, which is obviously crucial for making informed decisions. The third thing is sunk cost fallacy. So this is when you keep holding on to a losing position just because you've already invested so much time, money, or emotional energy into it. So you convince yourself that selling would mean admitting defeat, so you hold on and hope things will turn around even when all the signals are pointing the other way. You've got to learn to cut your losses, which is obviously brutal, but sometimes selling at a loss is the smart move if the fundamentals no longer support your specific investment thesis. So don't let past decisions trap you into a losing position. You have to remember that the markets don't care how much you've already invested. The fourth trap is overconfidence bias, which is obviously tricky because Bitcoin by its nature tends to attract people who are a bit more contrarian and independent minded, a lot of anti-fiat currency sort of folks. And that can lead to overconfidence where you overestimate your ability to time the market or predict price movements. And so it's easy to feel like a genius when Bitcoin is in a bull market, but that confidence can turn into arrogance very, very quickly when the market shifts. So how can you avoid this? Well, stay humble. Remind yourself that the market is always bigger, faster, and a lot more complex than you probably think it is. Even the pros get it wrong all the time. So use risk management, set up stop losses, and avoid going all in based on one singular idea. And so the last trap, recency bias. So this is when you place too much emphasis on recent events and ignore the long-term trends. For example, if Bitcoin just had a massive rally, you might convince yourself that the good times will never end. Or if it just crashed, you might panic and sell and think it's all over. So how can you avoid this? Well, you have to zoom out and take a look at the bigger picture. Bitcoin has had brutal drawdowns in the past, but it's also had incredible long-term growth. So don't let short-term price action distract you from your long-term gains. So those are the 5 psychological traps you got to watch out for as a Bitcoin investor. FOMO, confirmation bias, sunk cost fallacy, overconfidence, and finally, recency bias. They're all dangerous in their own ways, but if you can stay aware of them, you'll be a much more disciplined and successful investor in the long run. Make sure to drop a like and subscribe as it really helps the channel out. Thank you for watching. I'll see you in the next one.